So today, we are going to look at taking a policy withdrawal and comparing it with a policy loan. What we'll look at specifically is a case where someone plans on taking money from their life insurance policy and not paying it back. They don't want to. So let's take a look and have some fun. We're going to look at the same illustration we've looked at in the past few videos, but first, let's provide a little bit of information on withdrawals and loans, because sometimes the question comes up, what's the difference? So with a life insurance policy, you can take money through either a withdrawal or a loan. Let's put withdrawals here in purple. Withdrawing money is like taking money from a bank account, meaning if you've got money in cash value that's compounding, it's earning dividends and interest. Once you take money, it no longer earns interest. So let's say money taken, no compounding. So again, if you've got 100 grand in a bank account earning 5%, you pull out $50,000, how much do you continue to earn that 5% on? The remaining $50,000. Whereas with a loan, a little bit different. So when money is taken, what happens is one, you pay loan interest to the insurance company. However, what happens? You continue to receive dividends. So you keep on earning interest on loaned money. So a way to explain this, we can use the same example. You've got $100,000, this time in the cash value of a life insurance policy. You borrow $50,000. You pay interest on the $50K you've loaned. However, you continue to earn dividends and interest on what? Only the $50K remaining in equity that you could borrow again? No, it's on the full $100,000. So you continue to receive compounding on everything when you take a policy loan. So there's a difference there. That's a big difference. A couple other things, some technical items here. With policy withdrawals, typically it does not make sense to do this during the first 7 years. Or really, I can't do it the first 7 years because it can trigger a modified endowment contract. Whereas I can access loans, let's do it this way. Can't access money in the first 7 years. You can, but it'll often MEC. Whereas with a loan, I can take a loan anytime I'd like, and it will not trigger a MEC, which I don't want to occur. Withdrawals, I can always take up to my cost basis. Now what that means, cost basis, is the total dollar amount you've paid into a policy. So for example, if you take out a policy where you fund $250,000 per year for 4 years, which is the example we're going to look at, how much would you have paid into the policy? $1 million. That's the total out of pocket, also referred to as your cost basis. So with withdrawals, you can always withdraw up to your cost basis, in this case, $1 million, without any taxation. If you withdraw beyond your cost basis, so if you paid in $1 million, but your cash value is $2 million, anything above the $1 million that you take, even if it's not a MEC, you have to pay ordinary income tax on the gains. That's not fun. So most people don't do that. So typically how you work around this, you'll see this a lot in retirement where people will use a combination of both withdrawals and loans. Typically, they withdraw up to their cost basis. So in the example we have to the left, it'd be $1 million. And then once I hit $1 million in total withdrawals, then what I would do is flip over to loans, typically without paying any loan interest, because you can do that. And that's how I would continue to get the money out tax-free. Now with that said, what we want to make sure of there is that we don't overloan it to a point where the loan interest exceeds the earnings on the policy, which could trigger a lapse, and then we could have a big tax bill if it does lapse in a situation like that. That's rare, but we want to make sure that doesn't happen. It's my point, and I do like to mention that. So, with all of that said, those are some differences. What we're going to look at is this. We're going to look at the same case we have been looking at, which is the individual who paid in $250K per year for 4 years. That's a total of $1 million. And we're going to look at a withdrawal and then also a loan of $500,000. And what we'll do is with the loan, we won't pay anything back. Because here's the question people have. If I take a withdrawal, I don't have any loan interest that I have to deal with. However, I'm no longer earning dividends and interest on that money. It's gone. I pulled 500 grand out. The balance is what I continue to receive compounding on. Whereas with a $500,000 loan, I keep earning interest on the money in cash value and that $500,000 that is outstanding. So I'm getting interest on everything. That's where I'm attracted to it. I want to see what it looks like. However, because it's a loan, what happens? There's loan interest that will accrue if I don't pay it because you don't have to. How's it going to be satisfied? It will borrow against the death benefit, but how else? If I don't pay the loan interest, where that loan is taken from is my cash value. So it's really a game of looking at the numbers and seeing, okay, does the total interest earned outpace the interest due? And does it do it to a degree where I'm better off taking a loan instead of a withdrawal? A lot of fun stuff there. Let's look at the numbers. So what we've got on the left, entitled Safe, is an example or the illustration without taking any money. Just parking money, letting it sit and grow. Okay, that's great. Now let's look at the same policy where we take out that $500,000 withdrawal. What happens to our value? We took it out in year 8. Why we did year 8 is because it's after year 7. If we did this in year 7, we would trigger a MEC, which we don't want. Then we'd have some taxation that would occur. But in this example, $500K loan. There's your cash value balance, $650,000. There's your death benefit, a little under $1 million. Now in this example, we took this money out. It's not a loan where we can pay it back or anything like that. We cannot pay this back. So the balance that we have in this case is this guy. So now what's earning dividends and interest is the $650,000. The death benefit will grow with the cash value as well, so it does recover over time, but we're earning interest again only on whatever that balance is. Whereas with a loan, so with the exact same scenario, if you say, okay, I want $500,000 for my policy, but I'm not going to take a withdrawal. Instead, I'm going to take a policy loan. What happens? Well, here's your $500,000 loan. And look at the immediate impact. There's not much difference there when I look at the cash value, is there? No. The loan's a little bit less, a little bit more than $1,000, so not much of a difference here. The death benefit, however, is more attractive with the loan initially. So what's happening here? With the loan scenario, you're still earning dividends and the guaranteed rate on this, the remaining equity, the 646, and the outstanding loan balance. Another way to put it is this amount is still compounding for you in the growth column. And that again is in the loan scenario. Whereas with the withdrawal scenario, what's compounding for you is only the 650. That make sense? Okay. Let's look at this. Well, first, let's look at the values as time passes. Cash value difference. Let's also do death benefit difference. First 7 years, they will be identical. What happened? And this is showing the cash value and death benefit difference with the loan scenario. So specifically, what I'm looking at here, if I focus on the cash value difference column, is how much more or less I have in cash value if I take a loan instead of a withdrawal. The first year, I've got $1,700 less. Second year, $3,600. Small numbers relative to a $500,000 loan. However, what if I look at it at the time I'm 75, 25 years down the road? $41,000 less in cash value, still $200K more in death benefit. If we scroll down to our 80s and 90s, where we are getting near expiration, where we may kick the bucket, what do we notice? The values do become much more noticeable. You're 6 figures there in favor of the withdrawal scenario. So here's why. Here's the unseen. You'll see this on an illustration. So what's working against you with the loan scenario is this loan interest you're not paying. Now you could pay it every year, but if you just want to take money and not have to pay it back, that kind of defeats the purpose, doesn't it? I know a lot of people would express that. Another thing that's not seen in this illustration is what if interest rates go up? What if the variable loan rate goes up and it takes dividends a little bit to catch up? Well, that's going to work against you as well. So to kind of summarize all of this, taking a withdrawal versus a loan, most people we work with will take loans, but the reason why is because they do intend to pay it back or just want the option to pay it back, and they know if they do pay it back, what happens? Well, their values are fully restored to what they would have been as if they never touched it in the first place. So that's the appeal to a policy loan. I can use it like a personal line of credit. The withdrawal aspect is attractive to someone that says, okay, I've got money in here. I want to take money out and I'm not interested in a loan for whatever the reason might be, whether we think it's a good idea or not. That's what the policyholder prefers because it is their money. We want to remember that. That's what they want to do. It could make sense because I have no intention of paying it back. It is safer because I don't have to worry about any loan interest accruing and potentially outpacing the earnings on the policy. There are advantages to that. Now, the only thing we want to account for here is I took out 500, I paid in $1 million, so I can take out additional withdrawals of another 500,000. If I want to keep doing it after that, they would be taxed as income. So we probably would look to flip over to loans without paying it back, and we would see how much we can pull out without risking a lapse or anything like that. But we would look at that in a case like this. So I hope that you enjoyed this one. This question comes up enough. People are interested in it as far as getting money out. Not all the time, but it does come up certainly enough. So again, I do hope that this helps. Let us know your thoughts and if you have any questions at all, and we'll talk to you soon. Thanks again. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.